good morning, and good day to everybody. It's Friday, March 17th, and I'm Rustin Edwards, based in Geneva, with my illustrious world-traveling colleague and cohort, Mr. Matt Stanley. Good afternoon.
Greetings. Hello, mate. Hello, everyone. Happy Paddy's Day.
Oh, happy St. Paddy's Day. That is true. Happy St. Paddy's Day to all those.
I said no one's watching this today. They'll all be in the pub drinking Guinness, wearing stupid hats, pretending they know Irish songs, but actually they know nothing. But it's a good day for everyone. But yeah, no, it's been a good week. As Russ said, I was in Cape Town this week. In South Africa, I got back not that long ago. But no, a very good week.
Global jet demand. I applaud you for that. Got to keep the
trying.
Slide.
Me and the rest of the oil market we're trying to boost taxi demand as well with diesel getting around all over the place in Cape Town. But no, it was good. You know, it's nice to see everyone. Well, it was the first ARDA week back. It was the African Refiners Distribution Association. So it aggregates the majority of the African oil community. And of course, it's in Cape Town, so everyone goes. You know, what's the reason that everyone goes to Coltrans in Bali? It's because it's in Bali, right? I mean, you wait until the next Kepler big conference is going to be in the Maldives, and I guarantee you, everyone will be there. But it was nice. It was very good. The weather was nice. The chat was good. Everyone was pretty buoyant. You know, compared to the conversations that were on the agenda, say 6 months ago, which is what are you doing in order to reduce your carbon footprint? It was, what are you doing to ensure you can supply the world with oil? Because the majority of the world still needs energy, and a lot of replaced Russian flow is going to be looking, you know, people are going to be looking at Africa, and I think vice versa for where that Russian product ends up. So it was at times it was a little. I wouldn't say controversial, sensitive when it comes to some subjects. But yeah, look, we'll talk about it a bit later on. But in essence, it was a very good trip. Tiring one, but very good.
So question for you, what's the word on the street regarding the massive Dangote refinery in Nigeria?
Well, we asked about that a lot. So it depends who you ask, including Dangote. Quite how far along they are. We don't think, judging by the aggregation of info that we had this week, we don't think that will be operational until Q2 next year, 2024. And that's purely down to, well, myriad issues. One is construction delays, which happen across the world, not just Nigeria. I mean, look at the Al Zour refinery in Kuwait. I mean, that was delayed 3 years, I think. And now they've only just started up the second CDU, just exported their first, you know, solid cargo of sulfur. And it's, you know, the Al Zour has really collapsed the Fujairah market in terms of the 0.5 market. Premiums have gone from plus 20, mid-20s in December to sort of flat to minus now, because there's just a lot more oil than there was when you had the organic Uniper and Vitol material. But anyway, look, that's just a segue into what refining capacity is happening in the Middle East. But Dangote, I think one of the reasons it may be delayed is because if you're Dangote and you're looking at it from refinery optimization point of view and making money, feedstocks become a little bit cheaper in the last 6 months. So, and it depends where you look at, you know, I know they've got an agreement with NNPC, I think it's a 20% equity. So they'll take in 20% of Nigerian crude guaranteed, and then, you know, sort of have a direct swap with them for the products on the back of that. But you can't argue that if you are a Dangote, you look at the cheapest feedstocks because you can maintain still relatively high refining margins on the back of what's happening with global product demand. I wouldn't be surprised if they looked at some Russian crude as input into the refinery.
The only thing I would be interested with that is that on the complexity rating of the refinery, I mean, can they actually destroy Russian crude all the way down to petcoke? Or are they going to be, you know, if they ran Urals on a limited side of the diet, how much of that can they actually put through before they put themselves out of thermal balance and end up with a mishmash of products versus what they really need for the local economy? So, I mean, that it's always a question on what units they've built and how they're designed to process, because you think that they've made themselves a refinery that can process the organic homegrown crude oil first before you start bringing in import barrels that could change your product mix greatly.
Yeah, I mean, I think it's I can't answer that. I don't technically. I know enough, certainly today, about what the complexity ratings of the refineries are, but sorry. But I'd argue if it's not constructed yet, can they look at tweaking it based on current market dynamics? I'd argue yes. And, I think that what will happen, it's about your view on what the future of Russian energy off-takers looks like. I mean, it's not, we've had this chat before. It's not suddenly that at some point over the summer, everyone's going to forgive Vladimir and say, "Oh, come on, I'll take your oil again." No, this is a far wider problem, and it's a far bigger problem than perhaps Russia have thought about themselves in terms of, is that door shut permanently into Europe? Do they have to make new friends? I mean, I know you wanted to talk about, the fact that Premier Xi's going to, Putin's coming to Beijing this week to have discussions with the Chinese Premier, right?
No, it's the other way around. Xi is going into Moscow for the first time.
Oh, is he?
Yeah.
Wow. Yeah. See, I mean, what that means. I mean, how you digest that and sort of spit it out in terms of what it means for the oil price, I'm not so sure.
Well, I mean,
I haven't looked recently.
But I think from a geopolitical standpoint, if you look at, China is almost doing a full court press around the world, trying to make it look like they're making peace with everybody. I mean, they were part of the recent Saudi-Iranian agreement to chill their, let's call it the Gulf Coast or U.S. or Arabian Gulf Cold War, to make that, open up their embassies again and make them come back to the tables to talk. Xi had a conversation with Zelensky, and now he's flying to Moscow. So, is he going to try to patch things up or try to cool off the hot war that we currently have in Ukraine? Who knows? There could be an attempt to do that because, again, it is upending trade flows and making things a bit less certain when it comes to long haul and also relationships between different governments and different countries. I mean, so it is a big question mark. If he can patch up and at least bring people to a table to start discussing how can they cool off the hot war in Ukraine and make everybody happy, okay, great. But until then, I think people can fly, and energy security is still a big question.
Yeah, I mean, look, I'm looking at the numbers, and this is everything that China have imported from Russia. Again, we do a comparison to say March 2021. China imported 24 million barrels of across everything, crude, fuels, and everything. January 2023, it was 60 million barrels. So, the trend is certainly there. There's no denying that. But it drops off a little bit now. So I don't know if that's a maintenance thing.
You do have a big maintenance program, and we are going into the height of maintenance season in the northern hemisphere. I think at some point we're going to peak at around 8.2 million barrels a day of refining capacity offline between now and the mid-April, before gasoline season kicks in and refineries start coming back for maintenance. But the other thing is that running that heavy diet of Russian crude, they do need other crudes to come in to cut the cut points to where they actually make the product mix that they need for the economy. So you do still see, despite the increase in Russian crudes coming in, you still see a flow of U.S. crudes and West African crudes going into China as well as India.
I mean, the Indian diet is I mean, that's just exponential. Just referring back, February 2022. Russian Federation monthly exports to India were 4 million barrels in the whole of February, 4.7 million barrels. February 2023, there were 55.5.
Yeah, so
see, I mean, in terms of talking about, bosh.
So it's almost 2 million barrels a day coming in, but that's but still, I mean, the one thing about the cheap Russian energy coming into India is that at least it's helped India not suffer economically where other countries have had a hard time getting around this. I mean, it's actually contributed probably to the lack of inflation that you've seen in India, just because the energy has been so cheap.
Yeah.
With Russian flow coming in.
Yeah. Yeah. I mean, and I think that's, I don't know what right way to say that, because I suppose if you're leveraging off what we would say the economically vulnerable, right? So if you're looking at India, South Asia, Pakistan, Sri Lanka, place. I mean, India can't be compared to that. They are a superpower and one of the world's biggest economies. But breaking it down into how a Western power would look at it, you'd argue that what Russia are doing is going, do you know what? We don't need the West. We don't need the States. We don't need anything like that. We will go to those growth areas. Africa, I mean, that was, it was a big talking point this week, but I wouldn't say it was brushed under the carpet. It was just sort of, you could tell people didn't want to dwell on it, because I think it would have easily set the theme for the week. And that would have been, everyone would have spoken about, it's like, people didn't want, if you go into an OPEC meeting, you don't want to dwell on the fact of what's happening with possible Russia being pulled out. Africa, I'll refer back again. Africa in March 2022, as a continent from Russia, imported 3 million barrels, 3.4 million barrels of everything. March this year, it's 15 million barrels. So it's clear that that trajectory is more or less identical to India. China, not so much, but they're still buying a lot comparatively. But yeah, it's,
well, and
for me,
the one thing with China's buying is that what you don't see is the products that are being masked because they're being brought into other locations, blended, and then reshipped out. So you don't see that direct. There may not be a direct flow relationship that you can see with crude oil going into China, where you do see that in the Singapore market. The teapots are buying more bitumen mix because they had no crude allocation, and the bitumen mix is basically a blend of high sulfur fuels and some heavy crude oils to achieve a certain import duty waiver that they get going into China. And majority of that material is probably now Russian straight runs along with heavy crudes to turn it into that bitumen mix for their own importation needs.
Yeah, I mean, what's happened with the Singapore fuel market now? There's no Russian product allowed in the mix.
Well, you've got a very strong high sulfur market, and I think Al Zor is keeping the VLSFO market, which is the 0.5 sulfur, under cap.
Yeah.
So you do see a significant spread decrease between high sulfur and VLSFO.
Yeah, we just wrote a report about that, because high sulfur cracks have, since the beginning of March, have really sort of,
well, they've rallied.
Really went in now.
$14 a barrel in the last 3 weeks. High sulfur fuel cracks.
Wow.
Which high sulfur fuel cracks being the difference between high sulfur barges in Rotterdam on a product basis versus Brent. I mean, that is a massive move in change in value, because it was at minus $32 in February, and now we're talking minus 17, minus $16 a barrel.
Wow. And that's Singapore specifically, or I mean,
well, that's
Singapore
Rotterdam.
seems
That's Rotterdam. Yeah, that's the Rotterdam high sulfur fuel crack. Singapore's a bit higher, but nevertheless, it still shows that massive change in value. So high sulfur fuel no longer becomes the big discount barrel that it was. It's now becoming a bit more positive, helping to contribute to a stronger refining margin, because it's not so negative to make high sulfur fuel as it was 2 months ago.
Right. So where do you think all that Russian fuel will end up then?
Well, I think it's ending up in the east. I mean, you got to Saudi Arabia. If you look at Saudi Arabia, they're going into their summer. They're starting to acquire their oil for their summer burn program. And prior to the war, Saudi Arabia usually bought most of their high sulfur fuel from Russia. So that went straight into the Red Sea utility basin, which is used to desalinate water, run power generation for the air conditioning and what have you. So I think that flow continues. I don't think there's going to be any change in how Saudi buys high sulfur fuel to meet their utility needs. I think a lot of it's probably getting placed into the Middle East just for that. And whatever's not getting placed in the Middle East is being pushed down into Singapore and being blended into Chinese intake for bitumen to mix into the teapot refineries. So I would almost say that probably Russia's fuel exports are fully captured right now. and there's no
Wow.
stranded high sulfur fuel sitting anywhere. That would be my guess.
Yeah, and all the yeah, I mean, it's slowly starting to form, isn't it? Because all that Russian stuff is now replaced by, say, Iraqi straight run. So that's a pattern that's clearly there. And majority of the products, Black Sea is going into, say, Turkey and North Africa. And the straight run is going into, well, maybe going to the Middle East for power generation, allegedly. I sit in the Middle East, so I have no opinion, Governor.
Well, I mean, there can be no, but I mean, that's always been Saudi's buying habits for the last 10 years. So I don't see how that changed.
Sure.
Yeah. I would say the one probably big winner outside of tanker markets in this whole shift in flow has actually been the Egyptian government. Because if you look at the amount of Suez Canal transits that have happened, they're up massively year on year, as there's probably more flow since the embargo in Europe. All those Russian barrels flowing to the east, all transiting the canal.
That's interesting. Yeah, right. I mean, it's to. I mean, yeah. The other one that I would say is a winner. Not that there aren't any winners, but who's benefited the most, as you said, is probably what's been a fairly dormant part of the energy landscape, which has been North Africa. No, Algeria aside, but if you take Mohammedia, Laskira, Tunis, even Algeciras, which has been more active recently, but you know, those places now, and Turkey. Turkey has really been the home, I would say, the home for not the home, but the predominant activity area. I'm trying to be you know, legally kind of right here, and just maybe failing miserably, but you know, that they have emerged as the kind of new hubs. Well, is there anything wrong with that?
There's nothing wrong with that, because I mean, as long as flows are being done under the auspicious of what's legal, and currently with crude prices where they're at right now, I think every molecule of Russian oil is under the price caps. I mean, so it really kind of doesn't matter at the moment. You know, crude at $75 a barrel.
Yeah.
Gas oil, naphtha, fuel oil, they all price underneath the price cap levels and flow freely on Western and dark fleet tonnage. So it's you know, the lower oil price, you know, not only is it good for the general economy because it keeps inflation low and keeps cost of goods low and keeps you know, consumers in a more stable position because they're not having to spend more for gasoline and consumer fuels, but it also puts less risk to the whole Russian supply to the world because everything is under the imposed price cap by the G7.
Yeah. So what is it actually, going back to that first point then, so how is the freight market? I mean, I saw VLCCs went up to like 100 grand a day this week. Is that right?
Yeah, no, VLCCs and Suezmaxes are both on a very strong footing. Mainly it's all ton mile stories. You know, there are some delays on crude oil being delivered into China, because I think it's a case that, you know, China can take in a lot of Russian crude, but they need those other molecules of crude to come in to blend down the Russian crude to a more acceptable slate of products coming out of the refining sector. So you do see a bit of delays going on, which then contributes even more to the ton mile story.
And to put that into context, then, what was the market looking like in, say, February last year, 2022?
Oh, February 2002, freight markets for tankers was actually very weak. You'd say that earnings were negative for most tanker owners. VLCC rates were in the $2,000-3,000 a day level. When you have an operating cost of $22,000 a day, you know, negative earnings across the board. You can see that with all the publicly listed tanker companies, how their 2021, 2022 looked. Flip that around to where it is today, and you know, it's happy days. You're recovering all your losses you made in 2021 and 2022.
So it's kind of a perfect, not a perfect storm, because like I said, I don't want to harbor or labor the winners out of this conflict story. But when you had a freight market that was so weak, there was no new builds going into the market. And then suddenly the market went haywire after the conflicts and there wasn't enough tonnage about. And now it's gone from, like you said, the $2,000 to $3,000 a day to the $100,000 a day.
Well, and you also have to remember that during this time period, a lot of yard space was taken up by LNG tankers being built. because the flow of LNG is still something that needs to be taken care of in order to meet the energy needs of Europe. They're still looking at waterborne imports, and they need more ships to handle that flow, along with every other natural gas utility that has waterborne access. Container ships have taken up a lot of space because, again, the container rates at the time of 2021 and 2022 were through the roof at 20. They were getting 20,000 a box, which they're only getting $900 a box to $1,000 a box for the same routing. So there was a large investment, so that left limited slots open for tankers to begin with. Now you throw on top of this the whole energy transition story in the maritime world, where people are looking at decarbonization and new technologies. It also puts a pause on that new freight investment, because you don't know what technology to adapt to a ship that hasn't been built yet, and you won't have it until 2026, 2027. So there's a lot of other things around why the markets are where they're at, but nevertheless, there is a story of there's limited tonnage and limited new tonnage coming into the tanker market, which is helping the supply, keep supply for freight relatively depressed. So you have low supply, fairly good demand with long ton miles, therefore rates go through the roof.
And what about all these? Just last bit on shipping then. What is it? The majority of these ships are built with scrubbers, or are they looking to load 0.5 bunkers? What kind of fuel are they burning?
I would think that most new builds are coming out of the yard with a scrubber, just because when you look at the economics of a new build with a scrubber versus a retrofit, a new build, you're not taking something out of rotation, you're not taking stuff out of the market where you have a hot market to put a scrubber on. You want to keep your ships running as long as you can. So a new build, which has not been part of the freight trade yet, coming out with a scrubber makes economic sense in that regards. The other thing is that the installation cost of a new build is about 1/4 of that of a retrofit. So start thinking of that, and also the design of the ship is designed with the scrubber, not bolting a new unit on. So it makes things more easy and more efficient in the operation of the vessel.
Right. So if like, talking about high sulfur cracks going bid then, and a general depressed 0.5 market with market dynamics shifting, not depressed, but not as buoyant, let's say. What is to stop Russia building one of the world's biggest bunkering fleets with all these new ships that are going to come on into the market with scrubbers on board?
Well, I mean, they have a large bunkering fleet to begin with, and who's to say?
Oh no, but what's to stop them cornering that market?
Well, there's other areas of the world that Russia can't supply high sulfur fuel to. So when you look at the high sulfur fuel being supplied in Russian ports, I'm sure they're supplying all the ships that are in the dark fleet, moving Russian oil that is trying to avoid price cap trade, are probably running high sulfur fuel. Can't say that for certain. I can make a guesstimation, but they're probably running, because they don't really, if you're going to break the law, you're going to break the law. But when you look at scrubber fleets around the world, because scrubber trade is all over the world, and there's other places where you get high sulfur fuel. Middle East, it's very hard for Russian high sulfur fuel really to compete with the incumbent produced high sulfur fuel we get out of Iraq, you get out of Bahrain. So there's plenty of local high sulfur fuel molecules that if you have a scrubber fitted ship, you can just buy local and just move on and not worry.
Okay, I think it's going to be something. I don't know what it is, and I don't know what the right way to say this is. There just seems like a lot more of the way that the sort of Russian embargo has happened has almost, in a stupid, ironic way, and forgive me here and tell me to shut up, there's almost played into their hands. There's almost given them a sort of direct market share that perhaps they didn't have before.
Well, it's probably just like it's done with Europe. It's reorientated their mindset on how their oil was trading. Because to be honest, if you have your next door neighbor, the EU, buying all your waterborne exports for the most part, and buying all your pipeline barrels and buying all your product, you as a Russian refiner get lazy because you got a market next door. And you'd rather have that quick turnaround on your product versus trying to find other markets. So if anything, all this does is open up the eyes of Russia to wherever else can we sell oil and make a profit, which they seem to be doing quite well at.
Yeah.
And it also changes the purchasing habits of the EU buyer, saying, is there other places that we can actually get maybe better quality material that meets our local stringents versus having to do all this re-refining to make it meet the local requirements for product? And so you do change behaviors that might actually end up being more beneficial to both the buyer and the seller of the good.
Yeah, I mean, this is the yeah, that's a very good point. I hadn't thought of it that way, because it's only really been in the past few weeks. You've kind of, I suppose, if you've kind of got the, you know, you're coming out of St. Petersburg or Primorsk or wherever, and you're going, right, quite a few options here. I can go to Europe, I can go to the States, I can go into the Med, I can go wherever. And you're actually saying, well, I can't go to the States and I can't go to Europe. I can go to Africa, I can go to maybe Latin America, I can go to the East. It's kind of a new world order, isn't it? Well, it is a new world order.
It is a new world order. And it's probably, when you think of all of the shift in dynamics that have happened post-pandemic, and people are trying to look at more localized production, more localized factory production, localized energy production. I mean, the whole green transition, when you look at green transition, going from petroleum to green fuels, that is going to be a full, in my opinion, a full dynamic shift where you will see more localized energy production, just because that's the most efficient, least carbon intensive way of producing power, versus the current model where we're hauling material all over the world to meet a demand profile. And so, if anything, I think the biggest benefit of this whole refocusing on how oil moves around the world, especially in the eyes of where Russian oil is going, or other oils moving into Europe to backfill for the Russian oil, it just sets up the table for the green transition to be a more locally dominated produced market, versus building a hub in Africa and transporting green ammonia from the Sahara Desert into Europe. You might see more production happen in Europe.
Yeah. Okay. Well, I mean, it's starting to slowly sort of happen, but I was perhaps naively thinking that there would be a particular pivot point. We've spoken about it all year, when it's coming to, right, suddenly it's established where all the material is going and how it's being replaced, but it's a slow burn rather than a big explosion of data. It's rather than it's trickling in, the market's absorbing it. But I mean, moving on from that, the biggest bank that no one had ever heard of, SVB, kicking the nuts for the Bulls, right?
Well, I think the whole issue around the financial system right now is put a big wet blanket on people's bullish intentions on where the market was going to be. I mean, I think it's almost as if you're walking through your garden saying, "Oh, it's a beautiful garden," and you find that you see a rock on the ground, you pick up the rock, and you see maggots and worms underneath the rock. You go, "Oh, didn't realize that was there."
Yeah.
But once you've exposed it, you got to do something about it.
Yeah, I mean, it was just a brutal sell-off, wasn't it? I mean, SocGen were down at 20% at one point. ABM were down. There was no one who was sort of who was high and dry. Everyone was under pressure.
Well, it's a case of concentrated risk once again, though, because when you start unraveling the onion of why SVB failed, I mean, it was a case that they concentrated all of their risk on long duration bonds to help manage their deposits, and they never hedged it. And the Fed starts raising interest rates, and all of a sudden, all those bonds are out of the money, and now they have a liquidity problem. And it's the same problem that I think a lot of banks have in the States at this moment, because there is an accounting treatment on those bonds that if you hold them to maturity, you don't have to mark to market those bonds. And so they sit on your balance sheet at acquisition price.
I mean, that's madness. I mean, that's a kind of 2008 all over again. I mean,
that's the general fear that everybody has. I mean, if you looked at what happened on the federal short-term market window, $152 billion out to banks for short-term liquidity loans, which is higher than what it was in 2008.
Frightful. The thing is, I was listening to someone this morning. What does it mean for? I mean, the 2008 was a global crisis because there were so many people leveraged off, say, one financial system. Someone asked this morning, what does it mean for the Middle East banking sector? What does this fallout mean for the Middle East? And it doesn't really. There is no negative effect that's really happened on the financial systems here in the Middle East. And I would say that's the difference between 15 years ago and now.
I would put that with a grain of salt and a bit of caution, because how many Middle East banks through their funds might be invested in banks that have problems?
Oh, I'm sure there is.
And so to say that, oh, there's no issue here in the Middle East, everything's hunky-dory. Well, if the Saudi National Bank takes I don't know how many billions they've invested in Credit Suisse, but if Credit Suisse happened to go under and the Swiss government didn't bail it out, maybe Saudi Bank's a bad example because they have all the oil wealth to back them up if they really had a problem. But if you have a bank in Dubai that all of a sudden gets hit pretty hard because a bank in the States goes belly up and they were a big investor, and the shareholders are the ones that lose out first. It's not so much the bondholders. I mean, that could actually be the underlying issue that is not being talked about, because all those earnings, how do they sit on their relative balance sheets, and how do they sit within their funds?
Yeah, you're right. Look, I mean, it's it would be naive to think that there isn't some exposure to other markets apart for the Middle East financial sector, as apart from just the Middle East. But there was an air of kind of inevitability that something at one stage was going to kind of blow up, if you know what I mean. Whether that was a Silicon Valley based bank that no one had ever heard of,
there were two banks. Silicon Valley Bank, Signature Bank, the one in New York that blew up on the weekend. The Signature Bank one was a bit more, let's say, quiet, because that was basically catering to the cryptocurrency market. Yeah.
I mean, just before we wrap up, I mean, cryptos, did they go bid as a safe haven? I imagine gold has. Gold is 1930 now. Bitcoin is that?
Gold rallied and Bitcoin rallied even more. I mean, Bitcoin, I think, was up 50% from where it started the year at.
It's up 33% on the week.
Yeah, which is surprising for an asset that has no real value except what people are willing to pay for it.
Yeah, I'll just let them. We have another word for that, Russ, but this is a family-friendly program. So what are you looking at next week, mate?
Well, next week I'm also going to be contributing to the global oil demand by flying over to the Far East to make the rounds in Singapore. So I'm looking forward to that.
Nice.
But next week we've got the Fed minutes and the Fed interest rate decision, and that thing has been all over the map since Jerome Powell had his testimony in Congress saying 6% potentially, or higher interest rates for longer, I think was his actual term. The dot plot is now showing maybe 0, maybe 25, maybe 50 basis points. So it's a bit of the difference that 10 days makes between testimony and actual action.
Well, yeah, and I'm not sure, people searching for market direction, have we hit the pivot point? And then you see a part of the financial system move into somewhat of a perilous situation, and everyone's like, where should I be focused on now? So I think, it's all going to be, is there a swift change in dynamic and policy when the Fed have to react to something as quick as what's happened this week?
That's a good question. I mean, only the Fed can answer that. Now, like with the ECB raising interest rates 50 basis points and saying they're going to raise again, they're kind of setting aside the current financial turmoil, saying we still have an inflation problem. And the US still has an inflation problem. So I don't think they pass the ball and say, we're not going to do anything. I think they're still going to raise rates. They might slow the pace of raising rates just to see how the market absorbs it all. But I think it's foolish in my mind that people are betting on a Fed pivot in Q3 now. Yeah,
I mean, like you said, it's with the banking sell-off and just a general sell-off across, everything, across all markets. One thing that has sold off has been Brent, and has been gas oil, and has been gasoline. So that adds to the, to the consumer. It's a lower end user cost for them. Does that help the the argument.
Well,
I
it helps the overlying inflation. It doesn't help core inflation, because core inflation
yeah,
is the one that the Fed keys upon. That excludes food and energy pricing.
yeah, yeah, yeah.
So again, it's going to make next week will be a very interesting week.
Yes, mate. Well, listen, on behalf of all the TSB viewers, safe travels to the Far East and enjoy yourself. Like, comment, subscribe.
Like and subscribe and comment as you need. And we will be chatting with you all next week.
Yes, mate. All right. Cheers, guys. Good weekend, everyone.